Let's look at some examples of capital spending and the cash flow associated with selling investments, selling assets. So we want to know what the after-tax cash flow is expected to be if we purchase equipment for 110,000, tax rate's 40%. And the first is we're going to sell the equipment in 6 years for 17,000, and we're going to use straight line depreciation, depreciating to 17,000 over 6-year useful life. So remember the cash flow from the sale of the assets, the sales price of the asset, how much do we plan on selling it for? In this case, that's 17,000 minus the taxes paid. And the taxes paid is equal to the tax rate times the taxable gain, which is the sales price minus the book value, what we sold it for minus what it was worth. What was it worth? What we initially bought it for minus accumulated depreciation. So in this case, we know the sales price is 17,000. So now we just got to do some accounting work, figure out what the taxes paid were, expected to be, and subtract, and boom, that's what we expect the cash flow to be. So when we sell it, how much is it going to be worth? Well, we bought it for 110. We're going to sell it in 6 years, and we're depreciating it straight line over 6 years, so we'll have 6 years of depreciation, and the depreciation will be 15,500. And again, remember, 110 minus 17 over 6 is 15,500. So if we sold it for 110, we bought it for 110, and we took $93,000 in depreciation. At the time that we sold it, it was only worth 17. So if we sold it for 17 and it was worth 17, there was no taxable gain and there were no taxes. So we got a $17,000 check, did some accounting and realized that we had no taxable implications. 17,000 is our cash flow from the asset sale. What if we sell it for 17,000 in 6 years and we use maker's depreciation? And again, it's the standard rates, 33.33, 44.44, 14.82, and 7.41. And we're selling it in 6 years, so the depreciation years 5 and 6 will be 0. Well, we know we sold it for 17. Now let's do some accounting to figure out what taxes were. So again, 110 times 0.3333, 110 times 0.4444, 110 times 0.1482, 110 times 0.0741. And again, just as a quick review, those are the standard rates, and they're given in the problem. Zero in year 5, 0 in year 6. So if we add all that up, we realize that we bought it for 110. In the first 4 years, we took a total of $110,000 in depreciation. So when we sold it, it was worth 0. So we sold it for 17, but it was worth 0. So there's a $17,000 gain. 40% in taxes is $6,800. That goes to the government. So we got 17. We sent 68 off to the government. And so we had a profit of, not a profit, a taxable cash flow, net cash flow, after-tax cash flow from selling this asset we expect in 6 years to be $10,200. And what's interesting is with makers, the after-tax cash flow from selling the equipment is $10,200, which is less than 17 that we got with straight line. And the reason is because we got to use so much depreciation early on, especially in years 1 and 2, that we had higher cash flows there with makers. But as we understand time value of money, we'd rather have the higher cash flows earlier on because they create more value. How about if we sell it in 3 years for 50,000? And again, straight line depreciation to 17 over 6 years. Again, the approach is the same. In 3 years, we expect to sell it for 50,000. 50,000 going in the bank. How much do we expect it to be worth in 3 years? Well, after 3 years, we bought it for 110. depreciation of 15,500 per year. Again, 110 minus 17 over 6, so it's 15,500 per year. It doesn't matter that it's 6-year depreciation, but we're selling it in 3 years. It doesn't matter for depreciation. What matters is 6 years depreciation, which just means that at 3 years, not a lot of depreciation has been taken off. In fact, it's only 46,500. So the equipment is worth 63,500. So now we have an interesting situation. Oops, let's not do taxes yet. We know that we sold it for 50, but it was worth 63,500. It was worth more than what we sold it for. So there was actually a taxable loss. We lost 13,500. We sold it for less than it was worth. So taxes paid are 40% of that, and taxes paid are negative 5,400. What does that mean? What it means is we took a taxable loss, so we pay negative taxes. A good way to think about it is suppose somewhere else in the firm there was a gain of 13,500. They would have to spend or send 5,400 to the government. But because of this loss, it would offset that, meaning the company would save 5,400 in taxes. It's one way to think about the negative. We save 5,400 in taxes. So what's the cash flow in this case? The 50,000 that goes in the bank minus taxes paid, but in this case that's negative 5,400, 55,400. So what happened? We got a $50,000 check, put it in the bank. We also expect that because we're only selling it for 50 and it's going to be worth 63.5, that we take a loss, so we save 5,400 on taxes. So the overall after-tax cash flow is 55,400. And the general conclusion is that if you sell an asset for less than book value, there's a taxable loss, and the taxes paid would be negative, or taxes would be saved, and so the cash flow from the sale is actually greater than the sales price because you've got this negative taxes paid, you've got these tax savings. And so that's one way to think about it. Part 2 of the problem, you sell it in 3 years for 50 and you use makers. And so again, you're selling it in 3 years. You're using a 3-year schedule, but that means there's depreciation over 4 years. So what's going to happen is that, and that depreciation are relevant, and we'll use that to find the book value to figure out taxes and take it from there. So we sell it for 50. What was it worth? Well, paid 110. Depreciation year 1, 0.3333 times 110. Year 2 is 0.4444 times 110. And in year 3 is 0.1482 times 110. So over the first 3 years, $101,849 in depreciation is expected to be taken. So if we bought it for 110 and we depreciated 101,849 at the time of the sale in 3 years, equipment's only going to be worth $8,151 on a book basis. So taxes paid. If we sell it for 50 and it's only worth $81.51, we made a gain of $41,849. 40% of that, which goes to the government, is roughly $16,740. So the cash flow from the sale is we sell it for 50. 50 goes in the bank. We did some accounting, realized there was a $41,849 gain, so $16,740 went to the government, and we're left with $33,260. Be careful. One of the things students often do is they'll do 41,849 minus taxes, and that's the net profitability of the sale, which isn't especially relevant. We care about the cash flow, and so the cash flow has a real nice intuitive appeal. It's the 50,000. That's the check you get. You put it in the bank, then you do your accounting and realize you have to send $16,740 to the government. So that's another real check, but that goes out of your account, and so you're left with $33,260.